It seems everyone's got a side hustle these days. Maybe yours could be trading options. It can be a powerful way to pad your portfolio with some extra income or blow up your account if you aren't careful. And these days, the risks are coming in hot. But don't start sweating just yet though. Eric Pan's here to lend you a hand. This options trader is about to share the strategy that helps him keep his income machine humming even in unpredictable times. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, your guide to leveling up your investing skills with perspective from savvy DIY investors and financial pros. Presented to you, as always, by TD Direct Investing. I'm your host, Rob Moise, and Options Education Month here at TD Direct Investing is nearly over, but there's still a few more workshops on tap for you to check out, so head over to td.com/OEM for one last look. And if I do say so myself, we're rounding out the month in fine form on the show. Joining us is Eric Pan, founder of Ericnomics. He's a DIY investor and trader with over a decade of experience working in institutional finance, and now he's helping over 300,000 followers online learn how to invest and trade for themselves. Eric, it's wonderful to have you on the program with us. Appreciate you taking the time.
Thank you for having me.
So Eric, tell me, you were on Wall Street, you're working high-paying jobs. What made you walk away from all of it and start to become a financial content creator full-time?
Yeah, so I spent a decade climbing the ladder. The money was good, the titles were good, but I kept noticing that the financial knowledge that I was using every day, which felt obvious to me, that was completely inaccessible to most people. So I grew up watching my parents make financial decisions blindly without knowledge or tools. So I didn't want to keep that knowledge behind institutions or the people who went to school for it. So now here I am making educational content from Wall Street to Main Street.
I mean, it takes some guts to leave Wall Street behind and go full time as an entrepreneur, basically. When did you know the time was right?
Yeah, I don't think there was a moment specifically that I knew that time was right. You just kind of have to take the leap of faith and just, follow that.
Well, I feel like some investors right now watching are probably thinking about taking the leap into trading options. And I'm curious why you feel like this is one of the ways to grow your net worth.
Yeah, options are one of my favorite income supplements to my core investing portfolio. So I am a young investor with a long time horizon, also with a relatively high risk tolerance as well, too. So I am comfortable taking on the additional risk in exchange for potentially higher returns. And options give me a way to structure all of that.
But how long did it take you to get comfortable trading options for income? Because I feel like a lot of people, they start looking into it and they see options Greeks and implied volatility, and all of a sudden you start getting a little freaked out. So what was that moment for you when you're like, no, I think I got this?
Yeah, to be honest, I think it was probably a couple years. I want to say 2-ish years in order to kind of get comfortable trading options. It was more of a trial and error, I have to be honest. So I definitely lost a lot of money. And I like to say it as paying tuition, if you know what I mean. So I first started off by selling covered calls and cash secured puts. Then I moved into buying single-legged options. And then now I've sort of settled on trading spreads now.
Okay, well, yes, I've heard market tuition before. Let's see if we can maybe get some people a discount on their market tuition by listening to what worked for you and what didn't work for you. Let's get down to the heart of our conversation, and that's your approach to trading, as you say, credit spreads to reduce your risk during volatile and unpredictable markets like we're seeing today. For those in our audience, if you want to get in on the conversation, make sure you submit your questions to us. And we've got a little extra incentive for you to do so, because if you submit a question or a comment to us, you might get your hands on some pretty sweet option swag. We've got TD branded mugs, we've got hats with options inspired themes and catchphrases on them, and we've got a beautiful desk mat with option strategies and terminology on it. Great little cheat sheet there for your desk. Lots of great stuff could find its way to a lucky few, so don't be shy about participating. If you're watching on Webroker, you can use the chat box to send your questions to us. If you're watching on our broadcast platform, it's the questions and comments box you want to use. And if you're watching on our YouTube live stream, there's a link in the description you can follow over to our broadcast platform, and that's where you can ask your questions. All right, Eric, so like you mentioned, you started doing things like cash secured puts and covered calls for income, but you eventually sort of gravitated towards credit spreads. And I know your favorite trade is a put credit spread specifically. So tell us, how does a put credit spread work?
Sure, absolutely. So a put credit spread is a way to bet that a stock won't crash, and you get paid for making that bet. So here's how it works. You simultaneously buy and sell a put option at the same exact time with the same expiration date. One of them you sell to earn that premium. The other one you buy, which will cost you a little bit less. So you pocket that difference up front, and that difference is your income or your credit. So you win if the stock stays above a strike price by expiration, and you get to keep the whole credit and walk away. Now, if you lose and the stock drops through like both the strikes, and that's because your losses are capped because you also bought the put as well too. So that is what we call a risk-defined strategy.
And risk-defined is something that you like in unpredictable markets, basically because you know you're not going to lose your shirt, right? Like you can keep things in check.
Yeah, exactly. So I know exactly upfront how much I'm going to be getting credit for and how much I could potentially lose as well too. So knowing all of that information upfront is definitely really good.
It seems like this is a strategy where you kind of have to like thread the needle a little bit, right? Because if the stock goes shooting through the one strike, then you will have lost out on some opportunity for gains. And then if it blows through the bottom, like you've covered yourself a little bit, but then obviously the stock that you did this on is down too. So like how do you know when the right time to write a put credit spread is?
Yeah, absolutely. So I typically only stick with doing it on blue chip companies. So companies that I feel that have strong fundamentals, strong technicals, and companies that I originally hold in my own portfolio as well too. So there isn't exactly a right way to go about it. However, I do have my own criteria in order for those stocks to meet in order for me to start writing these put credit spreads.
Yeah, and we're going to get into all that good stuff. But I think, for beginners starting out, like the thing that's going to be top of mind for a lot of them is risk. And what am I risking? What do you think are the downsides of using a put credit spread in a particularly volatile, uncertain kind of market that we're sort of seeing today right now with all the geopolitical stuff going on and all that?
Yeah, and I got to be really honest. There is a lot of risks involved doing a credit spread, especially in volatile markets. While yes, you do see exactly your predefined max losses, it's usually a lot higher losses. So the risk reward is asymmetric and not typically in your favor. On a typical put credit spread, I'm just going to be throwing out a couple of examples. You might collect $100 to win, but you're risking many times over that if you do lose. Now, you are winning more often than you are losing, but when you do lose big. So that means one bad trade can wipe out several good ones if you're not sizing appropriately. And unfortunately, that has happened to me several times before, but fortunately, my wins have been more than my losses at least.
Yeah, and we're going to hear how you make that the right side of the equation that you're on more often than not, right? We're going to hear about that in just a moment. But before we dive into a specific trade that you did, just give us a sense, like how much money do you think a beginner would need to start trading credit spreads?
Yeah, realistically, you can start super small because a single contract requires little amounts of collateral, but it won't really move the needle. Realistically, if you want to make a dent, I think around $100,000 would be a better amount if you want to actually move the needle.
Mm-hmm. Okay, so this is like a larger size of money that we're talking about. I've heard other traders say you can start with as little as like, a few $1,000s or something like that. Do you think you could start with something like, $5K, $10K or something like that with credit spreads and still give yourself a chance to, make some money with it?
You certainly can, but of course, the smaller the capital that you're playing with, the smaller the credit that you'll be getting as well too. So you'll only realistically be earning a couple bucks here and there, unless like you're heavily on margin.
Okay, so maybe a starting point for somebody to dip their toes in the water, but then when it comes time to it, we gotta ramp up the capital. Okay, that's fair.
Exactly.
Let's get into an example though, because I'm a visual learner. I imagine a lot of people are visual learners too. Take us through a recent example of a put credit spread that you traded that worked out for you. I believe this one was on Tesla, so take us through it.
Sure, absolutely. So I did a put credit spread on Tesla. So here's how I structured it. I sold 10 puts with a strike price of $375, and I bought 10 puts with a strike price of $370. So both with about 10 days out. So typically I like to aim for about like 1 to 2 week time frame that I look for. And I gained $1,060 for selling, but I also paid $840 for buying. So I had a net credit of $219 right over there.
And like, how did you come to choose Tesla as the underlying stock for this trade? Because Tesla's pretty volatile, right? So what made you want to choose this one, particularly in the market conditions that we're seeing today?
Yeah, a few reasons that really fit my criteria. It has to be a company that I am fundamentally bullish on for the long term, as well as has to have good momentum. So typically, either flat or an uptrend would be good, or something that I would be looking at. Tesla offers high implied volatility, which also means typically better premiums. So good liquidity, good trading volume, all of that makes it easy to get in and out if needed.
And like, why not choose something more boring, like a more boring blue chip stock? Why did you go Tesla, and why do you like to write on tech stocks?
Yeah, absolutely. So Tesla has notoriously been a little bit more on the volatile side. So their implied volatility is a little bit higher. Typically, also with a higher implied volatility, you get these juicier premiums. Taking an example, if you compare that to, say, something like Apple, where it doesn't move as volatile, the premiums on Apple will be a lot less.
Okay, so you're looking for that to grab some of that income, and you know the offset, I guess, is a little bit more volatility you have to deal with. That's fair. What about those strike prices? How did you choose the width between them?
Sure. So typically, I like to take the subsequent strike price right underneath it. So there isn't really much of a methodology. That's just typically how I like to go about it. Now, how I set up my strike price in general is I do a quick technical analysis setup to make sure it's in a bullish trend, or at least not in a falling trend. So then I look for local supports, and I look for a strike price around there as well, too. In addition, lastly, I also look at the deltas. Anywhere from 0.1 to 0.2 is typically about like an 80 to 90% success rate.
Yeah, take us through delta, because this is one of the Greeks that I think is pretty pertinent, obviously, to follow, but also it's one of the easier ones to grasp, I think, in a lot of ways. So can you just explain delta to us?
Yeah, delta is probably the single most important metric that you'll probably be looking at. Now, it is essentially the change in the option price for every $1 of change of the underlying price. So think of it as sort of like how much amplification you are getting when looking at delta.
Mm-hmm. Okay, yeah. And that's a good explanation. I like that one. How do you adjust your strikes if you are in a more volatile market versus in a more tame market? Like, how do you think through that decision?
Yeah, in a volatile market, I try to go a little bit wider and further out of the money. So higher volatility also means potentially more price swings. So I want a little bit more buffer between the current strike price, the current stock price, and my short strike price. So I'm giving myself a little bit more room to be wrong, or what I like to call margin of safety. Now, the trade-off of that, of going more further away out of the money, means collecting less of a premium. But that's the right trade-off to make, in my sense, in my opinion. I'd rather earn a little bit less and sleep better at night than chasing premiums and blowing through my whole portfolio.
Mm-hmm, mm-hmm. So, like in the case of Tesla, like what made you choose the 375 and the 370?
Yeah. So, like I said, I would kind of look back a few months to look for local support zones, and then previously before that, I would look at the local support zones and then find a strike price slightly below that also meets the criteria for those deltas.
Mm-hmm, okay. Now, earlier this month, we were speaking with options trader Dan Passarelli, and he was telling us that he only sells options when implied volatility, or the IV, is high. Let's take you through his thinking on that.
And we'll say, hey, what does the implied volatility on these options look like over the past 6 months? Is it in the top half of that range or the bottom half of that range? If it's in the bottom half, then they might be cheap. If it's in the top half, they might be expensive, and maybe I should sell them. Is the implied volatility higher or lower than the actual volatility of the stock, the historical volatility? If it's higher, then they might be expensive. Might be a reason for me to sell them.
So, Eric, I'm curious to get your take on this. Do you only sell a credit spread when the IV is high, or are you a little bit more, I guess, not as prescriptive about that kind of thing?
Yeah. I totally respect that. High IV means typically fatter premiums, right? So, and as a net seller, that definitely works out in your favor a lot more. Now, I use implied volatility as one of my main inputs that I look for, particularly comparing implied volatility to historical volatility to see if the options are pricing in a little bit more fear than usual. Now, where I would push back slightly is when he said kind of like only trading around that. Now, I wouldn't wait exclusively for high implied volatility environments. You could go long stretches without putting on trades. And then also in low volatility environments, that means you could be leaving consistent income on the table. So I rather just adjust my strike prices and my sizing based on the environment rather than completely sitting on the sidelines, not waiting for anything. Mm-hmm. And the way that I kind of think about it is high implied volatility is a ideal situation, but it's a dial that I just kind of like adjust around. It's not like a hard on or off switch.
Yeah, it's kind of like the old thing where it's like if you wait until you're an expert to do something, you're never going to get started with it because there's always something more to learn, and it's kind of the same way with options too. If you wait for the ideal conditions, you could be waiting a while, right? So there's always some reason not to do something. So anyway, that's great food for thought.
Exactly.
Talk me through the expiration dates on that Tesla put credit spread you did. Like, why did you choose the ones that you did?
Yeah, so I typically like to aim for around 1 to 3 weeks, probably closer to the 1 to 2 week size, just because I can adapt and change accordingly if some news randomly breaks out, rather than say like if I did it 1 month out or 2 month out, where like if some news breaks out, then I would be sitting on that for a little while, just hoping that it would go back to my cost basis. Plus, also on the theta decay side, the closer to the expiration, the more theta decay there is as well too. So the 1 to 3 week time frame is usually the sweet spot for me.
Right. So you're giving yourself, hopefully, enough time to be right on the trade and not too much time that you're going to be wrong, right? Trying to thread the needle there. Okay, I can appreciate that. What about, you mentioned before, position sizing is very important. How do you think about position sizing when you're trading a credit spread?
Yeah. So you hear very commonly not to risk more than a certain percentage of your overall portfolio, say like 1%, right? Now, that's really good risk management, but I don't follow a strict rule of thumb per se. I'm not afraid to do outsized trades or double down on a trade, but they generally would be more than, I would say, generally within like about 5% of your portfolio, but also not afraid to outsize it when need be.
Mm-hmm. Okay, and then like when it came to this Tesla trade specifically, like what were you thinking about there? Like how did you know the right position sizing?
Yeah, for that one, I typically try to aim a little bit small and then size in as I go about. There are times where I write 20, 30, 40, 50 contracts at a time as well too, but I typically like to start small.
Okay, and what about, I think a big thing too is like you don't have to hold a credit spread to expiration. A lot of traders don't hold their options to expiration. When do you like to take profit? What are you looking for?
Yeah, I typically like to take profit around the 70% mark, just because that's where you've already realized most of the gains, and the remaining like 30%, the juice isn't really worth the squeeze because you're still risking your entire capital at that point too. Plus, if also there's plenty of time of expiration, I'm just ready to just lock in those gains and move on to the next trade.
Would you ever take a credit spread to expiration? Like what would need to happen for you to do that?
Yeah, absolutely. And there are plenty of times where I do so as well, too. The only times that I would do so is when I have 100% certainty that it will not go into the money. Because most of the time, it's just more worthwhile just to close it out, take your gains, take your profits, and then move somewhere else. So those are, I would say, I wouldn't say rare times, but maybe like 25% of the times I might leave it till expiration.
Okay, so good food for thought. Yeah, I mean, a bird in hand is worth two in the bush, right? So you want to just pocket the gains that you can and kind of move on to the next one, and hopefully you do it all over again.
Can't be too greedy.
Last question for you. How do you know when to throw in the towel on a credit spread? That just it's not working out for you? Do you like to adjust the trade at all, or do you kind of just throw in the towel? And when do you do that?
Yeah, sometimes it's not worth trying to adjust it because like you can't fix a broken trade most of the time. Something could be fundamentally wrong, or your thesis didn't work out. So sometimes you have to rip off the Band-Aid and just move on and just learn from that. Honestly, it's a little bit more of an art than a science, I have to admit. But after a little while, you do get a feel for it.
Is there something that you see in the way that the underlying stock moved, or some like news event or something like that that helps you make that determination?
Yeah, sometimes there are some external factors that you didn't foresee happening. If there's like a external catalyst like news events or geopolitical events that had happened that you didn't foresee happening, then that wasn't baked into your original thesis. Now, myself, I would never trade around earnings reports just because those are 100% going to be a coin flip. But news events of like geopolitical events and things like that, I can't foresee that happening.
Okay, so if something like fundamentally changes about like the underlying logic of the trade, that might be a sign to get out. But otherwise, maybe you could ride it out a little bit. Is that like a fair characterization?
Yeah, exactly. Sometimes you do have to bite the bullet and maybe just hold on longer, as long as you have a little bit more time until expiration date for your thesis to play out. And that has happened quite a bit as well too. While I'm deep in the red and then finally flipped into green.
Yeah, options can move quickly, right? So that's something for people to appreciate. But in any case, Eric, I appreciate you walking us through that example. Like, I think examples are super helpful just to help people wrap their head around stuff. So that's great. We got a lot more to get to with you as well, including our live Q&A. So hang tight for that, viewers. But listen, if you're enjoying the show so far, make sure you check out TD Direct Investing on social media. We're on YouTube, we're on Instagram, we're on Facebook. We got sneak peeks at upcoming episodes and a ton of other content designed to level up your knowledge. So scan the QR codes on screen. Check us out. We'd appreciate you smashing the like and the subscribe and all that good stuff. And hey, listen, you're going to appreciate it too because we got a lot of good stuff there for you. In any case, before we get to our live Q&A, I want to bring in my colleague Caitlin Cormier because she's going to show us how to trade credit spreads in TD Active Trader. Show us how to get going here, right? Caitlin, welcome to the program. Great to see you as always.
Absolutely. Happy to be here.
All right, so Eric was talking about his approach to trading put credit spreads for that risk-controlled income, or at least risk-defined in some sense. Walk us through how you could do that on Active Trader.
Yes, absolutely. Active Trader is a great platform, especially for these multi-leg type trades. And of course, there's always more than one way to do things. So I'm going to give you a sneak peek at one way, and then we're going to go into a little more detail on the second way to get this trade in. So let's go ahead and hop into Active Trader. Now, to start with, of course, you want to choose which security. I know that Apple got a little bit of shade there with kind of not juicy premiums. So maybe we'll switch over to something with a little bit more. For this particular example, we're going to come down here to the option chain, and we want to go, like we said, about maybe 2 weeks out. So I'm going to go ahead and hit on these ones that are 15 days to expiry. And then we're going to go on the put side of the option chain, which is going to be the right side. Now, we could go ahead and say that we want to choose our two strikes individually. So I could say, maybe I want to, under the bid side, sell this one, and maybe I want to buy this one. And that will create my spread right here with the two separate legs. But if you're looking to make life a little easier, you can actually come up here where it says spread and click vertical. And then the option chain, I'm just going to clear my data here. The option chain is actually going to show you as the spread. So it's going to give you your two strike prices in the middle here. And then because the dominant leg in this trade is we're looking for a credit, we're going to actually click on the dominant side there, and that will actually create our trade right here. So it's going to give us the two strikes. We can still make adjustments here to it, but it's going to net out the premiums against each other. So we're going to see our total net that we'll be receiving to place this trade all together on the order entry.
Okay, now great walkthrough. Now, of course, risk and controlling those potential risks, that's the name of the game, right, with credit spreads. So like, how could somebody get a sense of how much risk they're taking, what the risk reward is that they're sizing up here?
Absolutely. So With this, as soon as we hop in and we've got this trade on, we can actually hit confirm and send. Now we have a practice account, of course, so you don't have to do it with your own money. But when I click on that button, it actually will give me my max profit and max loss on the trade all together on this order ticket before I even hit send. There is another spot that we can see a bit more information about the spread and kind of see what our kind of risk reward would look like. If we simply right click on this trade that we have and click analyze, we can go into the corresponding tab at the top of our screen here, type in the company that's in question, and it will actually show us. Now, right now I do have a long stock position, I think. So it's showing me that on the chart as well. I'm just going to remove my stock, and it'll actually give me a graph here. Now I can remove the price slices. That's another piece of it. And then that's just going to show me, it's showing me two lines. One is showing me at expiry and one is showing as of today. And this gives us an idea that based on what the stock price is, what our total profit or loss on the trade could be as time goes by and as the stock price changes. So, and we have a whole video on this tool specifically within our on our YouTube channel or within Active Trader as well in the education tab. So if this has piqued your interest, just go ahead and check that out and get more detail on how it works.
Yeah, it's a really nifty tool. Thanks for showing that off. But of course, with all things options, there's a lot more to always learn. So definitely check out some of those videos that we have on the platform and on our YouTube channel. Thanks for that call out, Caitlin. And thank you for showing us the ropes as always. It's always great to have you. That was Senior Client Education Instructor Caitlin Cormier with us here at TD Direct Investing. And just a heads up to our viewers, there are still a handful of workshops to check out during Options Education Month at TD Direct Investing, like I mentioned earlier in the show. Here's a QR code that you can scan to see what's left. Plus, you can also check out past episodes of our live shows and on-demand videos to level up your options know-how. So don't forget about that stuff. And of course, look at this beautiful merch that we got on the floor here. We're going to take your questions in just a moment, but remember, this could be yours if you're one of the lucky few that submits a question or a comment to us in our live Q&A. Look at them. We got mugs, we got the hats, we got the desk mat. You know you want that desk mat. I want one of those desk mats. So I can only imagine how you guys are chomping at the bit to get them. So make sure you submit some questions to us. This could be yours. With that said, Eric, let's get into our live Q&A. You ready to go?
Let's do it.
All right. So our first question is coming to us from Charlene. Charlene wants to know, what technicals do you typically rely on most in your analysis?
Yeah, typically I'm not the biggest technical analyst by any means. I'm more of a fundamental analyst, but that's not to say that I don't use technical analysis to supplement my thesis now, or even entries. What I do typically look at is just very, very basic things like supports and resistances. That's pretty much as far as I will go in terms of like entry wise. Maybe I might wait for a better entry to wait for like a local bottom or support zone. And that's typically when I would try to take my position.
So Eric, when you're trading options and credit spread specifically, do you think it's the fundamentals that matter more or the technicals that matter more?
I would definitely say they go hand in hand as well, too. Because like I said, I wouldn't be doing these put credit spreads on companies that aren't fundamentally sound and that I am not bullish on. But I also use technical analysis to determine my strike prices as well, too. If there is a local bottom, I might put my strike price below the local bottom just to get a little bit more of a buffer.
Okay, that makes sense. So yeah, I mean, obviously they go hand in hand, but not overcomplicating things too, because I have heard like some traders say, you know, when you throw too many indicators on there, it's just noise. Like it's actually harder to make a decision than when you use fewer like you're doing. Has that been your experience?
Yeah, exactly. Like, you know, if you use too many indicators, it's just going to look like a mishmash on your charts, lines everywhere and rainbows and everything like that too. I like to keep it fairly simple. Don't overthink it and you'll be fine.
I have seen some people out there with like a bajillion and one things on there, and it just looks like something that my daughter would draw in daycare. Like there's just so much going on. I don't know how to make sense of it. But in any case, appreciate your perspective on that. Let's move on to our next question. This one's coming to us from Sudeep. What percentage of your portfolio is allocated to options versus individual stocks?
Yeah, most of my portfolio is in individual stocks. So I typically don't like to keep too much idle cash sitting on the sidelines. So I do have to admit, the options that I do typically do are using on margin. But of course, whenever I do enter in these options, I still size it appropriately where it won't like blow up my whole portfolio.
And like, do you think that there's like a certain level of your portfolio that you wouldn't want to see, you know, your options account exceed like as a percentage of your total account, or would you just let it run like as long as you're having a good time and it's working out, you just keep going with it?
Yeah, I think probably like a hard cap might be like 75% of notional value of my total portfolio is probably what I'm comfortable with. Because after that, like, a bad trade could go really, really south. And you spent many years building up that portfolio. So I think that's probably the max I would probably go.
Okay. Good food for thought. I know everyone's different, but it's always curious to hear like how much risk are you willing to take? Okay, in any case, let's get to our next question. Let's see what we have on tap. This one coming to us from Nadia. Eric, did you find it necessary to pursue any long-term education in economics to build your expertise, I assume as an options trader?
Yeah, absolutely. So I think having my undergrad in finance definitely did help because you learn this in school, the pure fundamentals, but that's kind of learning it in a textbook format in a classroom setting. But it's very, very different from applying it and practicing yourself. So that's why I think paper trading is fundamentally important in order to get your feet wet, to test it out, and to essentially to also pay tuition as well, too. So yes and no.
Talk to me a little bit more about paper trading, though, because that's a really interesting one. Because I've heard conflicting opinions on this. Some people say, yep, paper trade until you feel really comfortable. Others have said, it's only useful to a point because, ultimately you got to feel the pressure of real money to really know what you're made of. Where do you stand on that?
Yeah, I think paper trading is extraordinarily helpful because that's how you kind of get your feet wet without risking essentially anything. Now, however, trading in real life with real money versus paper trading is vastly different as well, too, because your emotions are tied. You are so invested literally with your money that you probably would be glued to the screen and your trading style would be probably vastly different than how you would have executed on paper trading. So knowing your emotions, it will be very, very different. So, but I would still say that paper trading does serve a fundamental use case.
Mm-hmm. Okay, so like the training wheels, if you will, before you start riding the bike, but you might have to scrape your knee a few times while you're learning how to actually ride a bike. Okay, that's fair. Let's get to our next question. This is like a group question here. We got Moyez and other viewers asking this as well. When trading credit or put credit spreads, how do you decide on the expiration date and the strike price? Does that vary by industry or sector? So we talked a little bit about your rationale between the expiration dates and the strike prices, but does that vary depending on the type of underlying that you're trading? That's a great question.
Yes and no. Just because, for example, if I'm doing it within the tech sectors typically are a little bit more volatile than, say, financials per se, right? So I might have to adjust a little bit more accordingly when I do it on tech versus, say, like a JP Morgan or something like that as well, too. But also at the same time, too, I'm looking at the implied volatility. So I am taking account in those expected volatilities while also selecting my strike prices and my expiration dates as well.
Mm-hmm. So it doesn't sound like there's anything radically different, but you are cognizant of like the volatility of the underlying that you're trading. That's like a fair characterization?
Exactly right.
Mm-hmm. Okay. Let's get to our next question. This one's coming to us from Amy. Amy wants to know, I still don't fully understand implied volatility. Could you explain it in simpler terms? That's right. Explain it to us like we're 12 years old, Eric. Implied volatility. Go.
Yeah, implied volatility is exactly what it sounds like. Implied volatility, so expected volatility. The higher the number, the more expected volatility there is. The lower the number, the more stable it is. So that's what the market is essentially pricing in on a number basis. Like, let's just say if like on a scale of like 1 to 100 or something like that, that's what the market is essentially saying how volatile this stock is.
And I guess just to add to that, the reason why premiums would be higher when there's higher volatility is because there's more variance in what could happen, essentially, right? Like you have to essentially pay for that side of the equation.
Yeah, exactly, right. So the higher the implied volatility is, the person buying or selling the option has to be compensated for that additional volatility as well, too. So that's why whenever you see options with a high implied volatility, they are oftentimes a lot more expensive because whoever is on the other end has to get compensated to take on that risk.
Mm-hmm. Okay, yeah. I think that's a pretty good explanation. Well done, Eric. It's not easy to explain some of these options concepts, but that was a pretty good shot. Let's get to our next question coming into us. This one's coming from Minko. How many credit spreads do you think is too many for a beginner to juggle at once?
Oh, okay. So I would definitely say start one at a time, especially if you're a beginner. You don't want to be juggling too many positions all at once too, because also at the same time, like, you want to have a deeper understanding of all your positions rather than, casting a wide net and just trying to collect as much premium as possible. You want to have a very deep fundamental understanding and a thesis behind all your trades. Now, if you're willy-nilly just opening random options contracts here and there just to collect premium, you're bound to blow up your account.
There's a little bit of like a Murphy's Law thing, I feel like, with option trading. I don't know, maybe it's just me, but like when things can go wrong, they will. And if you have a lot of trades open at the same time, you can get very easily overwhelmed if like whatever happened in the market drags a bunch of them down. And then you feel like you're putting out like 10 fires at a time. That could be pretty overwhelming. So I think that's a good piece of a perspective there, that just, start with one and then gradually build from there. That makes a lot of sense, particularly for beginners. Let's get to our next question. This one is coming to us from Anton. How much do you pay attention to the options Greeks when trading?
Yeah, a lot actually. But I only really pay attention to a select handful because those are the only ones that are relevant to me. So things like deltas and thetas, implied volatility, the volume, the open interest. I would say those are probably the ones that I pay most attention to. Everything else is probably just noise.
Mm-hmm. Yeah, I don't know. Personally, I can never wrap my head around like whatever the heck row is. I don't know. Like there's too many of them out there to consider. You got to keep it simple. It kind of goes back to the technical indicators point where like if there's too much on the screen to consider, like you sort of get lost in it all. So yeah, keeping it simple. I think that would be of good comfort to beginners too, like your approach. Let's get to one more. This one is coming to us from Cal Pete. How much do you typically manage a losing put credit spread before it reaches max loss? How do you deal with those situations? You were saying you sometimes rip the Band-Aid off, but if you are going to manage a trade, Eric, like how are you doing that?
Yeah, that's a really good question too, because it's a little bit more of an art than a science, because sometimes you might have to actually hold on to the contract closer to the expiration for your thesis to play out. I've had plenty of times where, I was in a green, then flipped deep into the red, but still had time left in my expiration date. So I essentially had to like hold on for dear life in order for it to like, swing backwards again too. Now, however, there are also other times where my thesis didn't really play out as well too. So I was just holding on to this losing trade while getting closer to my expiration as well too. So sometimes you just have to hold on to it, have a little bit of faith, but also that goes back into the original reason on why you even got into the trade to begin with too. Really understand and ask yourself, why did you get in? Understand your thesis. Now, if your thesis is, if you kind of think about it some more and you start to poke holes in your thesis and see something else, it might be time to rip off the Band-Aid. But if you have conviction, sometimes all it takes is just holding on and waiting a little bit longer.
Mm-hmm. Okay, so not trying to fiddle too much with it, just like sticking with your shot, taking your shot, and then like if you miss, you miss, you hit it. I think that also kind of make things a little bit easier for folks, provided you're sizing your risk appropriately. Anyway, that's all the time we have for our Q&A. Eric, appreciate you fielding all those questions. Great answers, and really appreciate you sharing your approach to trading credit spreads. Really interesting stuff. We'll have to have you back again too. There's a million and one more things we could ask you about options, but time beats us. But thanks for joining us.
Thank you for having me. Pleasure.
And of course, for our audience, we appreciate you tuning in as always. Make sure you check out next week's episode because we're challenging conventional wisdom. The 60-40 portfolio for retirement, it's been a go-to, but is it really enough to meet your financial goals, or is there an alternative that could make more sense? We're going to explore that topic with Veronica Popova from Vanguard. So make sure you tune in to find out what she has to say. That's all the time we have for this edition of the show. From everyone at Inside Investing, thanks again for watching. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.